Retail trading often begins as an exercise in drawing abstract lines over a screen. These loops, channels, and triangles are inherently lagging. They force the trader to rely on historical patterns rather than the order flow currently hitting the tape. This creates a central paradox. A trader can identify a visually perfect geometric setup only to have a single institutional block order enter the book and shatter the geometry in milliseconds. Professional trading floors operate on a different frequency. They replace artistic interpretation with high-speed data processing and raw order flow. Modern financial markets function as algorithmic liquidity engines, engineered specifically to harvest retail capital. Surviving this environment requires a shift from predictive pattern matching to the study of tape physics. Tape physics is the study of time-allocated cash settlement, volume delta, and the mechanics of liquidity. We are going to strip the chart of its retail markers and rebuild an institutional execution model from first principles. This construction relies on 4 distinct pillars: macrogravity, structural boundaries, momentum fuel, and algorithmic convergence. This layered architecture replaces subjective guessing with a deterministic execution model. The foundation of the matrix is macrogravity, which defines the overarching institutional tide. This chart shows the multi-timeframe mean. Institutional algorithms use these curves as dynamic velocity anchors that track specific participants. In a state of synchronized expansion, these timeframes align. The lines fan out in sequential order, and the price rides the momentum of the overarching tide. Traders fail by ignoring the mixed blender state. Notice how the lines collapse into a tangled knot. Fast attack algorithms push price lower, while macro desks absorb volume. This high-friction, violently dissynchronized environment means institutions step aside until the knot uncoils. Mapping macrogravity prevents a trader from fighting the institutional tide or getting liquidated during a zero momentum rebalance. We now add the second layer, intraday structural boundaries. A common retail tool is the initial balance box, marking the opening hours high and low wicks. High-frequency programs drive price past these to trigger breakout orders, then collapse it back. We replace this with a 20, 40, 50 cash settlement matrix, focusing on internal candle bodies. The 50% midline serves as session equilibrium, while the 40% edge lines represent dense walls of resting limit orders where institutional accumulation occurs. This grid provides the mathematical framework for engineered volatility and precise position sizing. The engine calculates risk units based on the current session's active structural range. This risk profile automatically adjusts contract sizes based on market volatility, decoupling the decision from human emotion. The tactical grid transforms chaotic price action into a structured, mathematically defined cage. The third layer of the system is momentum fuel, which monitors the raw order flow moving beneath the surface of the price candles. Volume follows a chronological lifecycle. Markets require an initial impulse to trend and a period of exhaustion to reverse. This begins with the A wave, the aggressive market order drive that signals primary institutional intent. Following the drive, the market enters the B wave environment, where algorithms often hunt for fresh fuel to sustain the move. Here, a deep liquidity sweep may occur. Price wicks sharply through our 40% grid wall, targeting clusters of retail stop losses. Institutions use this manufactured panic to fill their buy blocks. The B-wave histogram flags this passive absorption with a yellow signature, and price snaps back. What retail traders interpret as a structural breakdown is the engineered liquidity sweep required to fuel the next trend. The final stage of the volume life cycle is the C-wave engine. This panel tracks cumulative volume delta, which provides a primary metric for identifying trend exhaustion. This reveals the phenomenon of institutional absorption divergence. Price makes a higher peak on the top chart, but the corresponding volume bars on the histogram below print a lower high. This divergence indicates structural decay. The aggressive buying fuel has dried up, even though the price is still rising. The price rises only because passive sell orders are absorbing the final breakout chasers. Institutions distribute positions into this retail volume. When the aggressive fuel hits zero, the price collapses into a steep mean reversion. Cross-referencing price against volume delta exposes the rot inside late-stage trends, preventing a trader from buying the top. We combine these pillars to identify algorithmic convergence, which is a mandatory filter for execution. Any signal that occurs in isolation without structural alignment is treated as algorithmic noise. A nuclear junction occurs when these layers collide. The macrogravity line intersects the 40% edge line, while volume panels confirm institutional absorption at that exact coordinate. Only when tide, structure, and momentum are synchronized does the mechanical execution arrow trigger on the chart. This coordinate forces a violent price reaction because quantitative models across multiple institutional desks are mathematically triggered at the same millisecond. The final rule of the matrix is unconditional structural invalidation. While retail triggers move their stops based on emotional pain tolerance, institutional risk modeling relies on the failure of the structural thesis. If a candle closes solidly outside the 40% boundary and the pre-calculated risk unit boundary, the model is invalidated. The trade was engineered using the specific volatility of that session's structure. Closing outside these bounds means the statistical edge of the model has evaporated and the thesis is dead. Exiting immediately is a requirement of the system. Execution is a binary checklist. By mastering macrogravity, cash settlement grids, and volume delta, you can stop gambling on patterns and start navigating the market as a systems engineer.